Today, hardship is now on your credit file. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the Australian Banking Association says that borrowers who enter into a hardship agreement with their bank will now have that information recorded on their credit report for 1 year. As credit reporting bodies do not use financial hardship information to calculate a customer's credit score, a hardship arrangement is likely to be preferable to missing repayments, which stay on a credit report for 2 years. But before July the 1st, 2022, financial hardship arrangements were not included in the information allowed on consumers' credit reports, the ABA said. If a hardship arrangement was in place, missed repayments may still have shown up on the customer's credit report, and some lenders stopped reporting on a customer's repayment history during an arrangement, leading to a lack of consistency across the industry. The ABA, which represents 22 banks across Australia, that's around 90% of the market, includes the 4 major banks, regional banks, foreign subsidiaries providing regional banking services, and several smaller banks. New credit laws, which came into effect on July 1, have made it mandatory for licensed lenders to report credit information about their customers to credit bureaus. And they specifically provided for a credit report to reflect where a customer had entered into a hardship arrangement with their bank. The ABA CEO, Anna Bligh, spoke to MPA about recent changes to credit reporting and how brokers can help customers understand what will be recorded on the credit report and the importance of borrowers who are facing difficulty to talk to banks early, ideally before they miss a repayment. If a customer misses a repayment and doesn't speak to their bank, their credit score will suffer, Bligh said. Where a borrower's credit report shows they've missed repayments, that information stays on the report for 2 years as part of their repayment history, she said. They'll be shown as missing a month, and if they miss a second payment, it will be 2 months, Bligh said. If a customer starts to experience financial difficulty, for example, they lose their job, their hours are reduced, or they experience an unexpected event that affects their financial situation, they can contact their bank and enter into a hardship arrangement. This can be a temporary arrangement or a variation of the loan, Bligh said. An example of a temporary arrangement would be deferral of payments for a certain period, for example, for 3 months. Another option is to restructure the loan to reduce monthly payments. Instead of the number 1, 2, or 3, which indicates how many months the borrower has missed, there will be recorded either an A for a temporary arrangement or a V for a variation, Bligh said. Provided the customer meets the terms of the financial hardship arrangement agreed with their bank, their credit report will show they made their repayments on time for the period of the arrangement, she said. If the borrower enters into and complies with a hardship arrangement and their credit report has either an A or a V on it, that information will disappear from their credit report after 12 months. Where a new lender sees a borrower has a hardship marker, they will require an explanation of the circumstances that led to the arrangement and will want to confirm the borrower is now in position to afford the new loan, Bligh said. This protects both the customer and the bank from poor lending decisions. The ABA recently introduced credit report fact sheets for customers and financial counsellors, along with an FAQ to explain the changes. Those include information on the forms of help that banks provide and how financial hardship information can disappear from credit reports after a set period. Although customers are likely to contact the lender directly, brokers with clients who are struggling and at risk of running into financial difficulty may be able to speak to a lender's hardship team on their behalf, providing the customer provides authority, Bligh said. Banks are required to report customer defaults to APRA on a monthly basis. Despite the current inflationary and rising interest rate environment, Bligh said current data showed 90-day defaults were lower than they were back in 2019. Official cash rate rises typically take a few weeks to flow through to retail interest rates and then to borrowers' repayment schedules, Bligh said. Currently, most customers are only seeing the first two cash rates, those for May and June, reflected in the loan repayments. There's no evidence of any real increase in hardship today, but it's equally true that the full impact of the 4 interest rate rises have not yet hit the pockets of most customers. The cumulative impact of those, plus any more that might come down the pipeline in the next couple of months, will no doubt make life very tough for a number of customers. But on the upside, Bligh did acknowledge comments made by the RBA that overall Australian households were resilient to at least some rate rises, and a sizable percentage had built up savings buffers, putting them ahead on their mortgage repayments. But she expected some customers would find the cumulative impact of the interest rate rises difficult. Through their hardship teams, banks have the flexibility to help customers weather that storm, Bligh said. And Bligh said it was important that brokers advise struggling customers to contact their bank as early as possible, ideally before they think they're going to miss a payment. People find it hard sometimes to talk about this, and unfortunately that means they can get into more trouble. If people start doing things like using their credit cards to pay their mortgage, it starts to get very difficult to help them, Bligh said. Australian banks have an industry guideline to help them manage hardship issues, Bligh said. Given that keeping people in their homes is the best outcome, a foreclosure on a mortgage is the worst outcome for both the customer and the bank, she said. If they go straight away when they're really struggling, as mentioned, there are very practical things that banks can do to help them through, Bligh said. And Bligh acknowledged that many brokers had clients who they've worked with over a lengthy period of time and have built trusting relationships with. A broker can help customers understand what it means for the credit reporting, what a hardship arrangement means, and how important it is to get out of trouble before getting into trouble, Bligh said. And I will make the point again that I've been seeing quite a lot of evidence that banks are encouraging people to put their property on the market and sell to get out, rather than tripping into default. That pressure is quite severe at the moment. But I do also agree with what Bligh says. If people are in financial difficulty, they should talk to their lender very early. The longer you leave it, the less likely it is that they'll be able to help. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.